Welcome to Module 6 and the last module of Accounting 332. So this module is pretty different than all the others. So years ago, all the faculty inside the Lambton School of Accountancy got together and decided what to include in what is now numbered Accounting 332. And one of the things we decided we simply couldn't leave out is multi-state taxation issues. So from a business perspective, we're going to cover a little multi-state tax, barely scratch the surface. There's an entire graduate course on this topic, but you guys should emerge from this program understanding at least a little bit about state income taxes. So our learning objectives are, we're going to talk about the primary types of state and local taxes, and we're going to spend most of our time, like we have in the rest of the course, on income taxes. We're going to talk about whether a business has income tax nexus and try to determine its state income tax liabilities by computing state taxable income using both allocation and apportionment. And then lastly, we're going to discuss the unitary concept and how that affects state taxable income. Okay, let's start with Colbert Nation. So Colbert Nation is incorporated in the state of Delaware, which lots and lots of corporations are incorporated there. And it's not actually for tax purposes. It's actually done because the corporate law in Delaware is quite well settled. And even though it's headquartered or incorporated in Delaware, it's headquartered in Hollywood, California. And it has offices in Hollywood, New York City, and Chicago. And it serves clients in a wide variety of states. So the way it does that is employees from offices serve different clients. So it could be that employees in the California office work on clients in California, in Washington State, and Ohio. And New York, employees in the New York office may work on clients in Washington and Ohio and Illinois. And employees from the Chicago office may work on clients in Ohio and New Jersey and Massachusetts. And so the point is, what they do is they put the very best employees on the client engagement, kind of no matter where the client is, kind of presuming as long as the client's willing to pay for it. So if we were to look at Colbert Nation on a map, we'd see, well, look, they have lots of things going on in lots of states, right? And maybe some things going on in states that aren't on this map. And so, I mean, all the states are on this map, but they don't have a star or a square on this map. So if Colbert Nation generates $500,000 of taxable income, how do we decide what states get to tax Colbert's income? How much of it do they get to tax? And how do we go about calculating the right amount of taxable income in each state? And that's really, if I could distill it down to what this module is supposed to represent, it's this, right? It's answering these questions. So one of the things we start with is, what states get to tax Colbert Nation's income? And the idea is, or the concept is known as nexus. And we're going to talk more about nexus, but let's take as a starting point that states will say, I'm going to tax all income from whatever source, right? So think of it like Code Section 61 application, and they say, look, I don't care where you earned it. I don't care where you were. I want to tax all of it, because that's kind of in the state's best interest to some respect, to go with that sort of policy. So we've got Gene and Agnes Lipskowitsky, and they live in Utah. But each August, they come to San Diego to go to the beach. They wait till the water's a little warmer because Gene and Agnes, though they're getting up there, they like to surf. And so they want to surf without a wetsuit. Maybe they go to Black's Beach where they surf with no suit. And anyway, they come down to San Diego. And each visit, one of the things they want to do is go to Epic Wings and Things to get the wings, because they just love the mild buffalo wings at Epic Wings and Things. And so they find the easiest, most convenient San Diego location close to them, and they go and get their wings. Well, let's say that Utah, in its infinite wisdom, says, well, look, Epic Wings and Things, you sold to Utah residents, right? There's no question that Gene and Agnes are residents of the state of Utah. They're simply vacationing in your state for a little while. And so we're going to tax them. So how would Epic Wings and Things feel about not Nevada taxing their income? Nevada doesn't even have a tax. So Utah taxing their income. When Epic Wings and Things doesn't have a single store in Utah, doesn't have a single employee in Utah, and frankly has no real connection in any way, shape, or form to Utah. So you can see that Epic Wings and Things wouldn't feel too good about that. So nexus is defined as the minimum degree of contact between a business and a state that is necessary to establish jurisdiction, which is the legal way of saying what's the degree of contact necessary for a state to tax something. And since we're talking about businesses, we typically restrict this conversation to a business-oriented topic. The way states tax individuals is actually a little bit different. So each state defines nexus by itself. It gets to define that term individually. So there could be 50 different definitions of nexus plus the District of Columbia, so you get 51. In California, California says entities subject to the corporation minimum franchise tax, which is really our income tax here, include all corporations that meet any of the following. So if they're incorporated or organized in California. So California says if you're incorporated here, I don't care where you're doing business, you're subject to taxes here. You have nexus. If you are qualified or registered to do business in California. Okay, so whether you're incorporated here or not, if you're qualified or registered to do business in California, and California has a business registration process that, in theory, every California business needs to go through, they have the right to tax you, that you have nexus. But then lastly, they say, look, if you're doing business in California, and that's true whether or not you're incorporated, organized, qualified, or registered under California law. So even if you haven't done the things you're supposed to do, if you're doing business here, California is still going to try to tax you under their nexus law. And under their definition, the term doing business means actively engaged in any transaction. That doesn't say lots of transactions. That doesn't say some minimum number of transactions. That says any transaction for the purpose of financial gain or profit. Okay, so in case that wasn't clear to you, the state provides some regulations that say in the case of a corporation qualified with California Secretary of State but not doing business in this state, careful attention should be given to the term doing business. Okay, let's pay attention to this term. It is not necessary that the corporation conduct business or engage in transactions within the state on a regular basis. Even an isolated transaction during the year may be enough to cause the corporation to be doing business. So it kind of seems back we're square to one in terms of nexus. Any business connection whatsoever. Well, that simply won't do. What if you were flying, what if you worked in Massachusetts and you were flying to the West Coast, let's say Portland, and you had a stopover in LAX, right? So you went Boston to LAX, and then you're going to connect up to Portland. And so you're in LAX airport, you open up your laptop, you do a little bit of work, you answer a few emails. Is that enough to create a business connection? Have you transacted in any form in order for profit? Well, probably yes. So we need some savior, right? And there are two saviors out there. The first is the Due Process Clause. And the Due Process Clause requires that there be some link, some minimum connection between a state and the person, property, or transaction that seeks to tax, and that the income attributed to the state for tax purposes must be rationally related to values connected with the taxing state. So you'd say to yourself, well, is there due process if I'm working on my laptop in the state of California? Well, you might even argue there is, right? You're working in a public airport that's paid for by California taxpayer dollars. You're probably using the internet. That's part of the California airports. You might be willing to say due process is there. The Commerce Clause gives the federal government the right to regulate interstate commerce. And what's happened in something known as the Dormant Commerce Clause, what happens is the Supreme Court has said that they're not going to uphold any sort of tax. I shouldn't say that. They will uphold any tax against a Commerce Clause challenge so long as it's applied to an activity with substantial nexus. Okay, so at least it has to have substantial nexus with the taxing state. It's fairly apportioned. It doesn't discriminate against interstate commerce, and it's fairly related to services provided by the state. So wrapping up due process there in item number 4. Okay, so that gives us something to lean on. At least we're up to substantial nexus. But how is substantial nexus defined? Well, that's still entirely left to the states. However, there are a couple things that we simply know do provide an established nexus. The first is if you own or lease property or employ capital or property in a state. So you have an office building, you have a warehouse, you have a distribution center, you have nexus. If you have employees in the state, so if you have employees who are residents of your state or certainly work at an office in your state, then yeah, they have nexus. Or do you derive income from sources in the state? Any of those almost certainly establish nexus. There is one further restriction, something called Public Law 86-272. So Public Law 86-272 was passed by the 86th Congress. It's the 272nd law of that Congress. And it says an activity is immune from income tax if it consists of mere solicitation of sales of tangible personal property. So there's a lot in that dense statement. So it's immune from income tax. That doesn't mean it's immune from any other kind of tax. If it's mere solicitation, so it cannot be more than solicitation, of sales of tangible personal property. So it cannot be related to sales of services or intangible property. So fairly limited, but it's out there. So in addition, we used to have this case called Quill. And Quill was a sales and use tax nexus case. And it held that there had to be some physical presence necessary. However, there was a case about a decade ago called Jeffrey that created something called economic presence that had to do with the presence of intangibles in a state that started to erode away the physical presence till finally this month, as a matter of fact, and it was last week of all things, the Supreme Court overturned their holding in Quill, saying you are no longer required to have a physical presence in order to apply a sales and use tax nexus standard to a remote sales company. So if you've ever been able to buy something over the internet and not pay sales tax on it, that won't be true anymore. Now, Amazon got rid of that a couple years ago. Now it's done for just about everyone. Not everyone completely. We'll see what California does. But there are some factors, and once you cross those thresholds, the state can tax you even if you have no physical presence, which means no employees and no property in the state. Okay, so again, when we talk about these nexus factors, what are they? Owning property or employing capital, having employees, and what about independent contractors? Well, you say, well, look, I don't have employees. I'm making everyone independent contractors. And the reality is that doesn't necessarily insulate you from nexus. If those independent contractors are soliciting orders, that has been found to trigger nexus. If you derive income from sources within the state. So deriving income generally we think of as equaling sales. So what it really, the concept narrows down to is whether those sales are from within the state. And intangible goods, we typically think of as the destination state or where title transfers. So if I put something on one of my trucks in Oregon and I deliver it to a California customer in California, the destination state would apply. For services, we typically think of income as being sourced from where those services are performed. There's a number of difficult measures about whether it's more than 50% in one state or where the benefit is derived. That's beyond the scope of this course. Okay, so from a sales perspective, if Company A sells tangible goods to customers in all 50 states, do they have nexus in all 50 states based on sales alone if they ship the goods in their own trucks into each state? And the answer is probably yes, because they are employing employees and capital and property inside that state. If, on the other hand, they ship those goods using U.S. Postal Service or some other form of common carrier, for example, UPS or FedEx, if title transfers at the shipping point, then they may in fact not have nexus based on sales alone if they use that common carrier. Because now their trucks aren't going in there, someone else's are, and title transferred at the shipping point, not the destination point. Okay, that brings us to the end of our Nexus conversation and video 23A. Thanks for watching.